Transworld is a good exercise to do to see whether you really understand depreciation and trading transactions. Transworld is a subcontractor company for belts equipment, a manufacturer of heavy equipment being used by the mining industry. Trans has a fleet of trucks and trailers equipped to transport abnormal loads and is responsible for delivering this equipment to the mines. They are also registered for VAT, and we have to assume a VAT rate of 14%. On 1 March, let me just color that one in. On 1 March 2016, the beginning of the current financial year, the total book value or carry value, so the word of the fleet, amounted to 20.5 million rand. This amount was made up out of two amounts. 12,500 for the trucks. Now remember, this is clearly components. So the two components is trucks and the rest is for the trailers. So the trucks and the trailers is being added together in order to get the total value of the fleet. So in my IAS 16 note, I will have only one column, which will be the fleet, the motor fleet or the truck fleet. But in that column, you will have to add together all the calculations done for the trucks and for the trailers. The original cost price of the trucks was 36,090, exclusive of VAT. And the cost price of the trailers was 14,999,150, exclusive of VAT. The depreciation policy of the company is to write off depreciation over the estimated lifetime of the fleet on a straight line basis, for which 5 years is for the truck and 8 years is for the trailers. So although the trucks and the trailers makes up the total value of the fleet, there are different write-off policies applicable. Both is a straight line basis. So the accounting policy is that depreciation is provided on the straight line basis. That is the policy. And then 5 years, you have to also distinguish between what is the rates. So you will tell us that the truck's been 20% per annum, and then the trailers is 100 divided by 8, 12.5% per annum. The residual value of the trucks is estimated at 30% of the original cost price of the truck, and there is no residual values estimated on the trailers. On 1 August 2016, Trans has traded in one of his trucks for a new truck and received an amount of 792,300 for the truck. Received an amount. Now those words indicate that VAT is inclusive. The truck was purchased on 1 December 2014 for an amount of 1,026,000 VAT inclusive. So obviously we have to take out the VAT. Trans paid in 450,000 Rand cash on the trade transaction for the acquisition of the new truck. Now they wanted to prepare the following journals for the year ended 28 February 2017, the trading transaction of the old truck, the acquisition of the new truck, and then the depreciation for the year ended 28 February 2017. And this seems to be like a very short question, basically consisting out of 2 paragraphs. And what I'm going to show you now is that is fairly, not complicated, but involved calculations that you have to do in order to derive at the required part. Good, so let's just start building the block first with what we have. We said the total book value of the fleet amounted to 20.5 million Rand. Book value, carry value, 20.5 million in total. Now that 20.5 million was made up by 12,500,850 for the trucks, and the rest was for the trailers. So 12,500,850 for the trucks, so then I can calculate what is the rest for the trailers. Good, now we can continue. They say that the original cost price of the trucks was 36,090 exclusive of VAT. So 36,090 exclusive of VAT. I have the carry value, so now I can calculate what was the accumulated depreciation on the trucks up to the beginning of the current financial year. And the cost price of the trailers amounted to 14,999,150. So I can now insert that amount there, 14,999,150. This amount I've calculated, so therefore the balancing figure must be the accumulated depreciation on the trailers. Good. Now the depreciation policy is the straight line basis, 5 years for the trucks and 8 years for the trailers. The estimated residual value on the trucks is estimated at 30% of the original cost price and no residual values on the trailers. And then this was a trading transaction, but that was for the trucks. So absolutely nothing has happened to the trailers in the current financial year. So we can straight away go and calculate the depreciation charge on the trailers. Now, the cost price of the trailers, as we've calculated it here, all these amounts, I've just taken that and transferred it into this bigger column. So that first 3 line items is exactly this table here. So, on the trailers, which we're going to write off over an 8-year period, excuse me, and there's no estimated residual value, it means that our depreciation charge is going to be the 14,999,150 divided by 8, which will give us 1,874,894 for the current financial period. Now for the trucks, we have to do a few calculations. Let's have a look at the traded truck. One of the trucks was traded in for a new truck. The truck was purchased on 1 December for an amount of 1,026,000 VAT inclusive. So we're going to take out the VAT, and then we have to calculate what was the accumulated depreciation up to the beginning of the current financial year on that truck, plus for the current financial period to get the depreciation. Then we can work out what was the book value or the carry value of that truck at the date of disposal. And then we can also then conclude the transaction to work out what was the proceeds and how much was the profit or the loss on the sale of that truck. So good. Let's start then there with the traded truck. The cost price of that truck was originally 1,026,000, but that included VAT. So once we've excluded VAT, it gives us a total of 900,000. From 1 December 2014 to 1 March 2016, which is the beginning of the current financial year, a period of 15 months has lapsed. So I could have taken shortcut. We said, well, 900,000 less 30% of 900,000, and guys, it gives you exactly the same answer as to go straight away and say 900,000 times 70%. So that is after I've deducted the 30% estimated residual value. Over a 5-year period, and then the number of months that has lapsed from the acquisition date up to the beginning of the current financial year is 12 months here and 3 months there is 15 months in total. Yeah, I've done the calculation separately, but you could have saved time and just did it in one shot. And then those two amounts together will give you a total of 157,500. Good, so the carry value of this truck that we've traded in was 742,500 in the beginning of the current financial year. Firstly, we have used this truck for a period of 5 months in the current year. We've sold it on the 1st of August, so 1 March to 1 August equals 5 months. The depreciable value, here we work with the depreciable value, not the cost price, is 70% of the cost price, or 900,000 less 30% of 900,000 will give you exactly the same answer, divided by the 5 years period, or alternatively multiplied by 20%, multiplied by the number of months that we've used it, 5 months, which gives us a depreciation charge for the current year of 52,500. Good. The carry value then at the date of sale of this old truck was 690,000. What is the proceeds? How much have we received for the old truck? Now they've told us here we received an amount of $792,300 for the old truck. But remember, we have to take out the VAT because the VAT isn't ours. So the amount that we actually received, that actually will end up in our pocket, is only $695,000. So there was a profit of 5% on the trading transaction. Let's quickly do the journal entries for the disposal of this truck out of our books. Now the first thing that we have to account for is the actual depreciation in the current financial period. So what are we going to do? We will say debit depreciation, 52,500, credit accumulated depreciation on the trucks, 52,500. Then we're going to take out the cost price of the asset out of our books. We're going to take out the total accumulated depreciation out of our books, and we're going to transfer that to the asset realization or the asset disposal account. So the cost price of the asset was 900,000. To take it out, we have to credit the trucks at cost account with 900,000, and we will debit the asset realization or the asset disposal account of 900,000. The accumulated depreciation will now be 31,500 plus 126 plus 52,500, so in total 210,000. Debit accumulated depreciation was 210,000, credit the asset disposal or realization account was 210,000. And then in our asset realization account, we will have now a balance on the debit side, net balance of 690,000. What we're going to record now is the proceeds that we have received for that specific truck. Now remember, this was a trading transaction. Now with a trading transaction, although you're going to receive an amount for the asset that you've traded in, you have to pay in more to the same third party supplier an amount for the new asset that you're going to get. So he's not going to give you an amount and then you give him his money back. So at the end of the day, we're only going to settle the net amount. And that was this net amount of 456,000 that Trans has paid. So what we want to do really is to record the amount that at this point of time, the 695,000, the amount that the dealership actually owes Trans for that truck that they have traded in. So we're going to say debit creditors, which is the truck dealer, with a full amount that he is supposed to pay us, 792,300, 792,300. VAT output is going to be the VAT included in that amount, 97,300, which you're going to credit, and you're going to credit the asset disposal or the asset realization account with 695,000. Then you are here in your calculation. The only thing that you still have to account for is the profit on the trade-in. And the whole purpose of the asset realization or the asset disposal account is to calculate what is the profit or the loss on the trade-in transaction. So if you went along and you actually drew a T account for the asset disposal account, you would see that on the debit side of the asset disposal account, you need another debit of 5,000 to clean that account out, to make the balance zero. So the counter leg of that will be the profit on the disposal. So we're going to debit the asset realization account with 5,000, and we're going to credit the profit on the disposal of the truck with 5,000. Then we have recorded this whole transaction entirely. Now we have to record the purchase of the new truck. Now, what we need in the first place is what was the purchase price of the new truck. Now, they've told us that we have received 792,300 inclusive of that because we received that amount for the old truck. And then we have paid in an additional 456,000 Rand for the new truck. So the cost price, which in both instances, because it's a payment and a receipt, 792,300 plus 456,000, that two together will give us the cost price of the new truck. What we should remember, however, is that that will include VAT. So 792,300, take out the VAT, gives us 695,000. 456, the additional amount we have to pay in, take out the VAT, gives us 400,000. So the cost price, VAT exclusive, for the new truck was 1,095,000. Now, again, the estimated residual value is 30% of the cost price. So 1,095,000 less 30% of 1,095,000 multiplied by 7 months. We've used it for a 7-month period up to the end of the years, divided by 5 years, or alternatively multiplied by 20%. It will give you a total depreciation charge of 89,425 for the new truck. So let's go and record the acquisition of the new truck in our books now. The cost price of the new trucks was 1,095,000. There it is very clearly, 1,095,000. So we have to debit that account with that amount. VAT input is 15% of that amount. In this case, 14% of that amount, 153,300. So the total amount of the invoice that was issued by the truck dealer for the new truck was a total of 1,248,300. What is the outstanding balance now on the dealer's account? There was a debit of 792,300. And there was a credit of 1,248,300. So if you're going to deduct that amount from that amount, you will see that there's a balance still lying on the supplier's account of 456,000. So now we're going to debit the creditor's account, which is the dealer's account, 456,000, and we're going to pay him is 456,000. And then that whole transaction, the whole purchase transaction, was recorded. Let's complete our depreciation calculation. Remember, we had 36,090. That was the cost price of the trucks as at the beginning of the year. And we're going to take the 36,090,000. That was the cost price in the beginning. And the cost price of the trucks that we've sold was 900,000. So if we're going to deduct that from the 36, it means that the trucks that we had in the beginning of the year that we still have at the end of the year had a cost price of 35,190. Now, it's easy to work out the depreciation. The estimated residual value is 30% of the cost price. So 35,190 times 30% give you an amount that you're going to subtract that amount from 35,190, and that's going to be exactly the same as to do straight away 35,190 times 70%. We have used these trucks for the full year, so we're just going to divide it by 5 or multiply that by 20% for 5 years, and that then gives us a total depreciation charge of 4,926,600. So the depreciation that we haven't recorded as yet is that 4,926,600 plus a depreciation on the new truck of 89,425. So let's quickly go to that entry that we're going to pass through our books. Debit depreciation on the trucks, the 89,425 on the new truck plus the 4,926,600 on the old trucks. In total 5,016,025, going to credit accumulated depreciation 5,016,025. We've already calculated the depreciation on the trailers, so all we have to do is to write out the journal entry on those trailers. So we're going to debit the depreciation on the trailers of 1,874,894 and credit the accumulated depreciation on the trailers of 1,878,74894. Then we have answered the question. All I would like to show you then is, or draw your attention to that, is that in your IAS 16 note, only the total column, only this column was you're going to show in the IAS 16 note. You're going to do this calculation, you're going to do that calculation, but only, and then you're going to add all these figures together. So this here, that total column there, is the amounts that will appear in the IAS 16 note. And here I've completed all those amounts that you can see exactly how it would have been populated in the IAS 16 note. So that is very important that you know that in the IAS 16 note, you do not put down the details. So guys, please, if you're going to put down the details in the IAS 16 note and you're going to split it there between, you write it here, note only the totals. I know that the second year students last year had a similar kind of component type of question, and a lot of them have shown the details in the note, and they received no marks whatsoever for that whole question, not even a calculation mark because they didn't answer the question correctly. So in the first year I won't be that harsh, but you're going to lose a lot of marks. You're going to show me the trucks and the trailers in your IAS 16 note. I say again, only the total column for the fleet will appear in the IAS 16 note.